This is the Best Stocks to Buy podcast. Looking for quality stock tips? Well, we bring you timely investment ideas based on the latest stock and market outlooks. Our ideas are driven by a proprietary software that reviews, analyzes, and ranks over 6,000 stocks every week. So you may hear the name of a company you haven't heard of before. You know what? That is often the best kind of opportunity. An opportunity to get in early before the investing masses. The Best Stocks to Buy podcast is made possible by Kind Management Group, a registered investment management firm serving individuals, business owners, and family offices. Hello everyone, this is Matt Scott with Kind Management Group, and this is the Best Stocks to Buy podcast. Today is Tuesday, January 3rd, 2017, and this week we're going to look at the best dividend stock to buy right now. And on to our opening slide. It's called the Setup and the Approach. Now, as usual, the key objective of this podcast is to present to you a high probability upside potential stock. And the key tool we use is a financial model, a proprietary tool we developed that uses multiple valuation approaches across over 6,000 stocks that we review every week. So yes, we were quite pleased with what we developed, and we hope you find it helpful as well. So the view you're getting is not driven by some sensational headline and some popular publication focused on increasing readership, but simply based on the best investment opportunity. Now, an easy way of thinking about approach is to think about the method of triangulation that law enforcement uses to locate a cell phone. In our case, we use a form of triangulation to locate a future stock price using different valuation methods. Now, here's the backdrop. Now, I truly view creating such a model as daunting, but I believed I was well prepared for the challenge. I have both computer programming experience as an engineer and over $15 billion of transaction experience as a finance and development guy to judge the research I reviewed. So my approach didn't come overnight. I painstakingly reviewed over 40 years of white papers, taking away the best that each had to offer, and then added some of my own tested intuition to implement new data sets that weren't even available as little as 10 years ago. So furthermore, my model uses both historical and projected values and takes into account management's historical accuracy of meeting the projections they share with the public. A point worth remembering, these views are based on today. An unforeseen economic report, a regional conflict, a revised policy change can change these expectations tomorrow. And the benefit of using a professional money manager like Kind Management Group, a little soft plug there, is having someone experienced in making educated assessments about the uncontrollable, as well as having someone to readily share their opinion on whether a particular event is reason for concern. And now, so what did our model find for you this week? It turns out that the best dividend stock to buy right now is in the drug industry. Now, just to level set, I'll give you a quick overview of the drug industry. Here's a description. The drug industry is comprised of a diverse group of companies that serve the world population with a variety of medicines. No surprise there. But here are the 10 largest competitors by sales that trade on the New York Stock Exchange and NASDAQ as well. Number one is Pfizer, Novartis. Third is Merck & Company. Next is GlaxoSmithKline. And the fifth is Sanofi. The next five are Gilead Sciences, or AbbVie, AstraZeneca, Eli Lilly, and Teva Pharmaceuticals. Now, the growth drivers right now for the industry are the following. Continued innovation and research and development, aging population, and the Affordable Care Act. It's not gutted yet, but it's definitely driving drug demand. The industry challenges as of late, which we'll see if they continue, will be our congressional challenges on drug price increases. So those are the drivers and the challenges. And now for the big reveal. The best dividend stock to buy right now we found to be a company called Teva Pharmaceutical Industries. Their ticker symbol is TEVA, and we see the 6-month upside potential at positive 21%. And on to the quick facts slide. Here's a business summary description for Teva Pharmaceutical. Teva Pharmaceutical Industries Limited, based in Israel, is a global pharmaceutical company that develops, manufactures, and markets generic and proprietary branded drugs and active pharmaceutical ingredients. About 80% of sales are derived from North America and Europe. Teva's largest proprietary branded product includes Copaxone, used to treat multiple sclerosis, and Azilect for Parkinson's disease. Their website is www.teva, P-H-A-R-M, farm, tevapharm.com. The company was founded in 1901, and they have 42,888 employees. All right, on to the metrics slide. Over the last 12 months, the annual revenue for Teva was $20.3 billion. This is a sizable company. The net income over the last 12 months was $1.6 billion, and their cash from operations was $5.4 billion. And the operating margins for 2016 are expected to be 38.5%, and for 2017, they are expected to be 39.5%. So we expect to see a slight improvement there. On to the valuation metrics. The trailing PE ratio right now stands at 7.2. That definitely seems kind of low for a company with such healthy operating margins. And the forward PE ratio is expected right now is 6.5. And what that means is that analysts expect earnings to increase over the next year. The PEG ratio is well below 1. We calculated at 0.3. And the price-to-sales ratio is at 1.9. And the price-to-book ratio is at 1.3. And the enterprise value to EBITDA ratio stands at 11.7. Additionally, this company pays a very healthy dividend yield right now at its current price. The dividend yield stands at 3.8%, well above the 2% average. The average dividend payout ratio stands at 26%, which means the company pays out 26% of its earnings yearly as a dividend. On to the price chart. And what you will see for the price chart might scare you a little bit, because basically it's a stock that has declined fairly steadily over the last 12 months. In fact, the company is down 42% from a year ago. And the pullback is related to multiple negative news events over the past year. But we still see a great story here, and the company is very strong financially. So on to our next slide. It's called Looking Back and Looking Forward. Okay, so looking back. Teva acquired the subsidiary of Allergan, a company called Actavis, in August of 2016. The acquisition is expected to, 1, boost profits, create cost and tax synergies, and 3, diversify the company's offerings as it faces increasing competition on key multiple sclerosis patent expirations. Also, under looking back, there have been concerns that have emerged about the thinning margins in Teva's core generic drug business. The company was under anti-corruption investigation that started back in 2012, and Teva recently agreed to pay $520 million to U.S. agencies to settle violations. So a combination of all this news is what contributed to this strong stock pullback. So consequently, the stock experienced a pullback from around $65 per share down to around $37 per share where it is now. Now, looking forward, Teva will face increased competition from genetic drug manufacturers as their multiple sclerosis drug, Copaxone, experiences patent expirations. Teva is migrating patients from a once-daily multiple sclerosis drug to a more convenient 3 times a week version. That's a nice positive. And the severe stock pullback of 42% over the last year appears to be a market overreaction. As we will discuss, Teva has a strong balance sheet, strong cash flow, and is expected to grow despite its recent challenges. On to the next slide. the why now, the bull rationale. Here are the reasons why we view Teva as a good buy right now. The company is expected to experience decreased expenses per share going forward. The company right now has low valuation metrics, and in the near future, they're expected to have low valuation metrics. And additionally, the company has increased its debt. And increasing debt can sometimes be a bad thing, but in many instances, it can actually help boost the stock price. So, decreased expenses per share, that's partially due to efficiencies expected from its recent acquisition. The company has a low valuation metric right now due to its low price, and because of increased earnings projections, it's expected to have an even lower valuation metric in the near future, and the increase in debt tends to help a stock price. On to the summary slide. The financial statement quality for Teva Pharmaceuticals is excellent. The operating margin trend is flat. It's expected to increase a percent, but it is very strong and healthy. The price pattern trend, as we mentioned, has been declining. We just see it as a bargain opportunity right now with a great balance sheet. The industry outlook, we will classify it as flat, while the company is expected to grow as well as other drug-related companies. Because of regulatory uncertainties, we'll just take a neutral outlook. And additionally, overall, our market outlook is flat. The GDP figure for third quarter was very healthy, so we don't expect it to be as healthy in that 3.5% range, but maybe around the 2 to 2.5%. So we view GDP as flat right now. Now, the recent closing price for Teva Pharmaceutical was $37.30, and our 6-month price target is $45.13. And that gives Teva an 6-month upside potential of 21%. So it's for all these reasons that we believe that Teva Pharmaceutical is the best dividend stock to buy right now. We hope you found this presentation helpful, and we'll talk to you soon. Take care. Hello everyone, this broadcast was made by Connor Management Group. We are a registered investment advisor and money manager for individuals, businesses, and family offices. We are not your typical financial advisor in that we invest our clients' funds directly into individual stock positions. We do not put our clients into other stock mutual funds. At Connor Management Group, we help you grow and protect your assets. We craft high growth investment portfolios for your children and other minors. We manage the rolled over assets from 401k accounts. We manage IRA and trust accounts. So how do we go about serving our clients? One big differentiator is that we developed some pretty comprehensive computer software that reviews, analyzes, and ranks over 6,000 stocks on a weekly basis. And from that, we create concentrated investment portfolios of well-researched and closely watched stocks. Furthermore, we operate under a managed account arrangement, and that means you open and fund a brokerage account in your name, and we simply manage your investments electronically. That gives you, our client, the greatest control and transparency possible. You can learn more about our service at www.connermg, that's CONNERMG.com. Additionally, we've set up a group on the LinkedIn platform. The name of our group is simply called Stock Investing Tips, Better Returns, Bigger Pockets. Now, this is a private group, which means you have to click the Ask to Join link. We do this because we want to be able to control the quality of the member experience. So if you like what you heard and you would like to receive more timely investment information and be able to post questions, just send me a message to ask to join our LinkedIn group. You can readily find my profile on LinkedIn. It's Mathis Conner, that's MATHISCONNER. And if you have any problems connecting, just send me an email at mathis@connermg.com. Well, that's all for now, and I'll talk to you in our next broadcast, or hopefully with you in our LinkedIn group. All right, everyone, have a great week.